There are warnings that sound small when you first hear them. They don't come with charts. They don't come with economists. They don't come with glossy brochures from equipment dealers. They come from an old man standing in a cold barn, looking at his sons, saying something so simple it almost sounds foolish. Never finance tractors or equipment. That was the rule. Stay with me until the end. Before we begin, please take a moment to like the video, subscribe to the channel, and comment where you're watching from. Now, let's get into it. And in the winter of 1973, when America's farmland looked like it had discovered a permanent golden age, that rule sounded outdated, primitive, almost embarrassing. But within 8 years, that single sentence would split a family's future in two. You have to understand the atmosphere of 1973 to feel the tension in that barn. Corn was over $3 a bushel. Wheat had exploded. Soybeans were setting records. Export demand was roaring. Land values were climbing so fast, farmers joked they were making more money sleeping than working. Banks were not cautious anymore. They were aggressive. Loan officers drove out to farms. Dealers offered financing packages with low introductory rates. Agricultural magazines ran headlines about modernization and scale. Expand now. Upgrade now. Leverage your equity. Get big or get out. It felt like history had changed, and in the middle of that noise stood Elijah Carter, 72 years old, black. Born in 1901 to sharecroppers who owned nothing, a man who had watched his father lose 2 rented farms during the Great Depression. A man who had survived not because he was lucky, but because he refused to owe. By 1973, Elijah owned 520 acres in southern Iowa. Not prime river bottom gold, but good, workable land, debt-free. His tractors were old, a 1959 diesel that smoked blue. On cold mornings, a 1963 model with patched fenders and a stubborn starter. Implements welded and re-welded. Nothing impressive, but every piece of iron on that farm belonged to him. No bank lien, no monthly statement, no interest clock ticking in the background. That January morning he gathered his sons inside the machine shed. Wind rattled the tin roof. Their breath hung in the air. Marcus, the oldest, 41. Broad shoulders, confident, always the first to speak. Daniel, 38. Thoughtful, calculating, the mediator. Isaiah, 34. Quiet, observant, slow with words, fast with tools. Elijah leaned against a workbench and said what he had been. Preparing to say for months, I'm dividing the land this spring. Each of you will take your share. Farm it how you want. The sons nodded. Then came the sentence. But hear me now. Never finance tractors or equipment. Silence. Marcus shifted his weight. He had heard this rule since he was a teenager. It was practically family scripture. Elijah continued. I don't care what the banker tells you. I don't care what your neighbors are doing. The minute you owe money on iron, you're not a farmer anymore. You're a debtor working for the bank. Marcus smiled politely. Dad, he said, times are different. That sentence, times are different, has destroyed more farms than drought ever did. Marcus laid out his reasoning calmly. Corn's over $3. Export demand is strong. Land's going up 20% a year. If I buy new equipment, I can double acreage. Payments will be covered easily. We're not in 1932 anymore. Elijah didn't argue loudly. He didn't raise his voice. He simply said, cycles don't disappear. They pause. Daniel spoke next. I'm not planning anything reckless, but we can't keep running 20-year-old equipment forever. Repairs cost money too. Isaiah said nothing. Elijah looked at him. What about you? Isaiah shrugged slightly. You farmed 50 years without losing the land, he said quietly. That counts for something. Marcus exhaled in frustration. We can't farm scared forever. Elijah's eyes hardened. It's not fear, it's memory. And that was the last formal conversation about it. Spring came, the land was divided, and within 3 months, the 3 brothers chose 3 different futures. Marcus moved first. He walked into the regional farm credit office and leveraged his inherited equity. The loan officer practically welcomed him like a partner. $65,000. 7-year term, 8% interest, monthly payment just under $1,000. He signed without hesitation. Then he visited the dealership. Brand new tractor, 125 horsepower, 6-bottom plow, 8-row planter, modern tillage equipment, shiny green paint, clean glass, comfortable cab. It wasn't just machinery, it was status. He rented an additional 240 acres from a retiring neighbor. Suddenly, Marcus wasn't a 170-acre farmer. He was pushing 400. He ran numbers every night that spring, when bushels per acre. $3 corn dollars, gross revenue near $144,000, subtract operating costs, subtract rent, subtract payments, plenty left. He felt smart, progressive. Ahead of the curve, Daniel took a more cautious route. He financed a used tractor, 5 years old, smaller. Loan. Lower payment. He kept his acreage at 170 and told himself he'd scale gradually. Isaiah did something different. He financed nothing. He tore down the old 1963 tractor in his barn, rebuilt injectors, replaced seals, machined bushings by hand, bought used parts from salvage yards, repaired rather than replaced. His brothers drove past and shook their heads. "He's wasting time," Marcus said once at the grain elevator. "That thing will never match what I'm running." Harvest came strong. Rain fell at the right times. Temperatures held steady. Marcus crushed it, and bushels per acre. Sold at $290, his net income after payments was higher than anything he'd ever seen. He bought a new pickup truck that winter, took his wife out to dinner in town, talked openly about buying even more land. Daniel made solid money, not spectacular, but respectable. Isaiah's yields were slightly lower, around 108 bushels per acre, but his costs were dramatically lower. No rent, no loan payment, lower fuel consumption. When the math settled, Isaiah actually cleared more profit per acre than Daniel. But Marcus was still king. He had size, he had shine, he had momentum, and in boom years, momentum feels like intelligence. Then came late 1974. Corn softened. Not collapsed, just softened. $2.50, still profitable, but tighter. Fuel prices jumped because of the oil crisis. Fertilizer rose sharply. Marcus noticed his margin shrink, but he shrugged it off. Temporary correction, the bankers said. 75 brought further decline. $2.20 corn operating costs rising. His tractor developed a hydraulic issue. During planting. Repair bill, $200. He didn't have that in liquid cash. He used a short-term note. It felt minor. It wasn't, because debt doesn't just multiply money, it multiplies stress. For the first time, Marcus felt something unfamiliar at bedtime. Calculation. He started mentally projecting worst-case scenarios, but pride pushed the thoughts away. Daniel felt the squeeze too, but his smaller scale insulated him. Isaiah adjusted quietly. He reduced fertilizer application rates, delayed non-essential purchases, fixed everything himself. Flexibility is invisible in good times. It becomes priceless in bad ones. By 1976, weather turned unfavorable. Excess moisture early. Disease pressure mid-season. Yields fell across the county. Marcus still had 400 acres, but lower bushels. His gross revenue dropped sharply. His payment did not. The bank draft hit every month like clockwork, rain or drought. Profit or loss. The bank collected. He cleared barely enough to justify the scale he was running, and something shifted internally. The equipment that once symbolized progress now represented obligation. Daniel started keeping detailed spreadsheets. At night, running scenarios. What if corn drops below $2? What if rates rise? Isaiah, meanwhile, had accumulated savings. Every profitable year, even modestly profitable, added to his reserve. He crossed $60,000 in cash by the end of 1976. He could have upgraded. He didn't. Elijah watched from his porch in retirement. He didn't lecture. He didn't gloat. But sometimes he would look toward Marcus's place and sigh, because he recognized the pattern. Boom. Confidence, leverage, pressure. History repeating. Just wearing newer paint. In the winter of 1977, the brothers gathered again for supper. The conversation felt different. Less laughter, more numbers. Marcus defended his strategy. I just need prices to stabilize. Elijah stirred his coffee slowly. Prices don't owe you stability. Silence. Marcus bristled. I'm not losing the farm. Elijah nodded calmly. I know. Not yet. That not yet hung in the room long after dinner ended. Chapter 1 of their story wasn't about collapse, it was about divergence. One brother believed scale would outrun risk. One believed balance would protect him. One believed debt itself was the risk. And the market, indifferent and unemotional, was preparing to test them all. Because the most dangerous years are not the ones when prices crash overnight. It's the slow squeeze, the gradual tightening, the creeping interest rates, the rising input costs. The unpredictable weather, the kind of pressure that doesn't break you immediately, it erodes you, and erosion is harder to notice until the ground gives way. By the end of 1977, Marcus still looked successful from the outside. Shiny equipment, large acreage, busy schedule. But inside, something fundamental had changed. He was no longer farming freely. He was farming to service a number. And once you farm to service a number, you stop making decisions for the land. You start making decisions for the loan, and that shift, invisible, subtle, is where this story truly begins. Debt doesn't knock the door down. It doesn't arrive with sirens or shouting. It slips into the room quietly, sits at the kitchen table, and waits. By the winter of 1978, Marcus Carter still looked like the most successful farmer in the county. 400 acres under operation. Modern tractor, clean cab, wide planter, new pickup in the driveway. If you drove past his fields, you'd think he was the future. But success on the outside and stability on the inside are not the same thing. Corn slipped under $2. Not a collapse, just a slide. And slides are more dangerous than crashes because they allow you to keep believing things will recover. Marcus kept telling himself the downturn was temporary, exports would rebound. Inflation would lift commodity prices. The government would intervene. Something would happen. It always had before. But while he waited for something to happen, something else was happening quietly. Interest rates were rising. National inflation was spiraling. The Federal Reserve began tightening monetary policy. Operating loans became more expensive. The first time Marcus felt real tension was at the bank in early 1978. He walked in confident. He left uneasy. I just want to extend the operating line, he told the loan officer. The officer adjusted his glasses and spoke carefully. Rates have adjusted. You'll be looking at 11.5%. Marcus blinked. It was 8. Yes, inflation. That word had become the excuse for everything. Fuel was climbing towards 70 cents a gallon. Fertilizer costs had nearly doubled since 1973. Parts were more expensive. Repairs were more expensive. Everything was more expensive, except corn. Corn stayed stubbornly low. Marcus went home and spread numbers across the kitchen table. 400 acres. Average yield 115 bushels. Corn at 1.98. Gross revenue around $91,000. Subtract land rent. Subtract fuel. Subtract fertilizer. Subtract seed. Subtract insurance. Subtract labor. Subtract maintenance. Subtract his equipment loan. The margin that once felt generous now felt fragile. Daniel was feeling it too. But Daniel's payments were smaller. His acreage was smaller. He wasn't comfortable, but he wasn't gasping either. Isaiah? Isaiah was calm. His yields were slightly lower, but his costs were dramatically lower. No rent, no monthly equipment. Payment. No pressure to expand to justify machinery. If corn dropped further, he could scale back inputs. Delay non-essential purchases. Plant fewer acres. Flexibility. Marcus had none. Because when you finance equipment, the equipment dictates your scale. He had to keep farming big. Otherwise, the math collapsed. In the summer of 1978, his planter gearbox failed mid-season. The repair bill came in at $3,400. He didn't have it in liquid cash. He added it to his operating line. That was the moment the spiral truly began. Not because of the amount, but because of the habit. Borrow to repair. Borrow to plant. Borrow to bridge the gap. Each note signed felt small. Together, they built weight. At night, Marcus started waking up at 2 a.m., not because of noise, because of numbers. He would mentally replay scenarios. What if corn drops to 1.75? What if yields fall below 100 bushels? What if interest hits 13%, he would reassure himself. Next year will be better. Hope is powerful, but hope without structure is gambling. Daniel began visiting Isaiah more often that year. They would stand in the barn and talk quietly. "You think Dad was right?" Daniel asked one evening. Isaiah didn't answer immediately. He rarely did. "I think Dad understood cycles," he said finally. Daniel exhaled. "I thought I was being careful." "You were," Isaiah replied, "but careful with debt is still debt." By late 1978, Marcus had accumulated original equipment loan, repair debt, operating line at higher interest. His monthly obligations were no longer just one payment. They were layers. He started pushing harder in the fields, longer days, more acres worked per hour, less preventive maintenance. He needed volume. Volume would fix everything, but volume in farming depends on things you cannot control. Weather. And in 1979, weather turned against him. Spring was late and wet. Planting was delayed. Fields compacted. Yields suffered. Corn rebounded slightly to around 230. But it wasn't enough to offset the reduced bushels. His gross revenue improved slightly over 1978, but operating costs had ballooned. Fuel approached $1 a gallon. Fertilizer was punishing. Interest rates crept even higher. For the first time since 1973, Marcus ended a year with almost nothing left after payments. He didn't tell many people. Pride is expensive. At church, he still looked successful. At the grain elevator, he still spoke confidently. But inside, he knew the margin was gone. Daniel made a decision in early 1980 that shocked the family. He sold, not because he was bankrupt, because he could see the trend line. He ran the numbers honestly, interest rising. Commodity stagnant, input inflation brutal. He sold his land while it still held value, paid off his loans, walked away with capital intact. When he told Marcus, the conversation was tense. "You're quitting," Marcus said flatly. "I'm protecting my family," Daniel replied. "From what?" "From what's coming." Marcus shook his head. "You're overreacting." Daniel didn't argue. He simply said, "I'd rather leave farming with money than leave it with nothing." Isaiah said, little, but he respected Daniel's clarity. By late 1980, the national economy was in turmoil. Inflation was raging. The Federal Reserve under Paul Volcker began aggressive rate hikes. Prime interest would soar above 20% within a year. For farmers with variable operating debt, this was catastrophic. Marcus walked into the bank again. This time the atmosphere was different, less friendly, more guarded. "We need to restructure," he said. The loan officer leaned back. "Your debt-to-asset ratio is tightening. I have land. Land values are softening." That word hit him harder than any number. Softening, land, had only gone up for a decade. But now auctions were showing lower bids, buyers cautious. Credit tighter. Marcus left the bank feeling something he hadn't felt since childhood. Fear. Not panic. Not yet. But fear. That fall, drought hit parts of Iowa hard. His yields dropped below 90 bushels per acre. Corn at $225, gross revenue around $81,000, operating costs. Even trimmed were near $55,000, loan payments relentless. He barely covered obligations. There was no cushion, no savings, just survival. The big tractor, once a symbol of power, began showing signs of strain. Heavy use, deferred maintenance, stress. It started overheating during harvest. He pushed it anyway. Time was money. One afternoon, white smoke poured from the exhaust to engine damage. The dealer inspected it. Full rebuild, the mechanic said. About $5,000. Marcus stared at the estimate. $5,000 might as well have been 50. He went to the bank. Denied. He approached a private lender. Approved at 18%. He signed. Because when debt is already heavy, the mind stops calculating. Long-term consequences. It focuses on the immediate fire. Fix the tractor. Finish harvest. Survive the year. That winter of 1980 was the first time Marcus admitted something to himself. He wasn't farming freely. He was farming under obligation. Every decision was shaped by payment schedules. Plant more acres. Apply more. Fertilizer. Chase yield. Chase revenue. Because stopping wasn't an option. He had to keep running. Meanwhile, Isaiah continued farming his modest acreage. His old tractor still ran. He maintained it carefully. He avoided pushing it beyond reason. He had crossed $120,000 in savings. He didn't brag. He didn't expand aggressively. He simply stayed solvent. The difference between the brothers was no longer visible in equipment. It was visible in posture. Marcus carried tension in his shoulders. Isaiah carried patience. One evening in early 1981, Marcus drove to his father's house. Elijah was older now, slower, but his eyes were sharp. Marcus sat across from him at the kitchen table. "I might need help," he said quietly. Elijah listened. "I can loan you money," the old man said. "But on one condition," Marcus waited. "You sell the financed equipment, downsize, clear the debt." Marcus stiffened. "I can't farm 400 acres without that tractor." "You don't need 400 acres," Elijah replied calmly. "You need ownership." Marcus stood up. "You don't understand modern farming." Elijah's voice stayed level. "Modern farming still bows to cycles." Marcus left without taking the offer, because sometimes pride costs more than interest. By spring of 1981, the bank sent a notice, 3 months delinquent. Bring the loan current or collateral will be seized. Collateral. That word landed heavier than any number. The tractor wasn't his partner anymore. It was collateral. And chapter 2 of this story ends there. Not with collapse, but with inevitability. Because once leverage turns against you, and rates climb, and yields drop, and prices stall, the math stops caring about effort. Marcus worked harder than ever, longer hours, more stress, more pressure. But farming under debt is like running on a treadmill that slowly increases speed. At first, you keep up, then you strain, then you stumble, and when you fall, the machine doesn't stop. It keeps moving. Chapter 3 would not be about struggle. It would be about consequence, because cycles don't ask permission, they simply turn. And by 1981, the turn was complete. There is a moment before collapse when everything goes quiet. No shouting, no drama, no thunder in the distance. Just silence. That was the spring of 1981. Marcus Carter stood in his yard before sunrise, staring at the tractor that had once made him feel unstoppable. The same tractor that had doubled his acreage, the same tractor that neighbors had admired, the same tractor that had convinced him the old rules no longer applied. Now it sat there like a question he could no longer answer. 3 months behind. The high. Letter from the bank wasn't emotional. It didn't accuse him. It didn't insult him. It simply stated terms. Bring the account current or the collateral will be seized. Collateral, not your tractor, not your equipment. Collateral. For 8 years he had defended his decision, 8 years of telling himself the downturn was temporary, 8 years of believing scale would outrun risk. Now the numbers were final. Corn prices had not recovered. Interest rates had climbed, past anything farmers of his generation had ever seen. Some operating loans were pushing 18%. Prime would soon crest beyond 20%. Fuel costs remained high. Fertilizer was punishing. Land values had begun to slide. That last one hurt the most because land had always felt permanent. It always went up until it didn't. At church that Sunday, Marcus noticed something new. The conversations were quieter. Neighbors weren't bragging about expansion anymore. They were whispering about refinancing, about auctions, about banks tightening credit. A farm 20 miles east had just been repossessed. Nobody said the word foreclosure loudly, but everyone knew. Daniel, now living in town after selling out the previous year, drove past Marcus's fields one afternoon. He saw the wear in the soil, the stress in the equipment. He didn't feel vindicated. He felt uneasy. Because farming wasn't just business. It was identity. And watching your brother lose identity is different from watching him lose money. Marcus tried one last time. He drove to the bank with his books carefully organized, yields, forecasts, projections, a recovery plan. The loan officer's tone was polite but distant. Your debt-to-equity ratio is too tight. Land values are falling. We can't extend further credit. Marcus felt heat in his chest. I've been with this bank my whole life. The officer nodded, and we appreciate that. But appreciation doesn't override math. The meeting ended without resolution. On the drive home, Marcus didn't turn on the radio. He didn't think about the weather. He thought about 1973, the barn, the wind rattling the roof, his father's voice. Never finance tractors or equipment. He had interpreted that as fear. Now he understood it as experience. The repossession happened in June. 2 men arrived in a pickup with a trailer. Professional, efficient, not cruel. Marcus signed the release papers. Without speaking much, he watched as they loaded the tractor, the planter, the plow, the machinery that once symbolized growth. Neighbors pretended not to look. In rural communities, people respect privacy, but everyone sees everything. The auction was held 3 weeks later. Equipment that had cost over $60,000 in 1973 sold for a fraction of. That markets were flooded with repossessed machinery. Supply overwhelmed demand. The sale didn't cover the balance. Marcus still owed money. Debt does not disappear when collateral leaves. It lingers. The bank required land to be sold to satisfy. The remainder. Land his father had protected through drought and depression. Land that had survived 2 generations of struggle. Marcus signed the deed with a steady hand. Inside, something broke. Hard work had not failed him. Structure had. He had worked longer hours than either of his brothers. He had chased yield relentlessly. He had maximized production, but he had built the operation on leverage, and leverage multiplies. Outcomes. When prices were high, it multiplied gains. When prices fell, it multiplied damage. By late 1981, the farm crisis was in full force across the Midwest. Land values dropped by nearly 50% in some counties. Interest rates stayed punishingly high. Foreclosure notices spread like a silent epidemic. Thousands of families left land that had been in their names for generations. It wasn't laziness. It wasn't stupidity. It was leveraging, colliding with volatility. Isaiah watched all of this from a different position. He still farmed modest acreage. His equipment was older, less impressive. But his books were clean, no liens, no letters, no interest clock. He had accumulated nearly $150,000 in savings by 1981. While others liquidated under pressure, he waited. Patience is invisible in boom years. It becomes powerful in collapse. That winter, the bank approached him quietly. 200 acres of foreclosed land were available at a reduced price. Cash only. Isaiah ran the numbers carefully. He did not rush. He purchased a portion. Debt-free. He did not celebrate publicly. He understood what that land represented. Not opportunity alone, but someone else's loss. Marcus moved into a smaller rented house in town that fall. He found work in agricultural supply, steady, predictable income. He avoided driving past the land he once farmed. Night, he replayed decisions. Not because he didn't understand them, but because hindsight is precise. It highlights each fork in the road, each moment when pride overruled caution, each time he chose scale over stability. One evening, he visited Isaiah. They sat in the barn, tools hanging on the wall, old tractor resting quietly. "I thought I was being bold," Marcus said. Isaiah nodded. "You were. I thought Dad was stuck in the past." Isaiah wiped grease from his hands. Dad wasn't against growth. He was against dependency. Marcus stared at the floor. "I worked harder than ever, I know. Hard work is not immunity. In farming, effort does not control prices. It does not control rainfall. It does not control interest rates. It controls only input, and when leverage magnifies risk, input alone cannot save you." Elijah Carter passed away in 1983. He lived long enough to see the crisis unfold exactly as he had warned. At his funeral, Isaiah spoke. Not dramatically, not emotionally. Simply. "My father wasn't afraid of modern equipment. He was afraid of owing on it." He paused. He believed the only safe farmer was the one who could survive 2 bad years without asking permission from a bank. Marcus sat in the back pew. He did not feel anger, he felt clarity. The 1980s farm crisis would erase hundreds of thousands of operations nationwide. Communities shrank. Schools consolidated, rural banks failed. The survivors had something in common: low leverage, not better soil, not better luck, lower debt. Isaiah continued expanding slowly through the mid-1980s, buying small parcels when cash allowed. Purchasing used equipment at auctions for a fraction of original price. He never financed machinery, not because he feared it, but because he valued flexibility more than speed. By 1986, he owned more land than the 3 brothers combined once controlled. Debt. Free. His son began working beside him, learning the same rule, not as superstition, as structure. Years later, someone asked Isaiah if he ever regretted not scaling aggressively during the boom of the 1970s. He thought carefully before answering. Sleep, he said. That was his measure. Sleep, not acreage, not horsepower, not appearances. Sleep. Marcus rebuilt slowly in a different way. He invested conservatively, saved diligently, avoided debt whenever possible. He never returned to large-scale farming, but he carried a lesson that outlived the loss. The story is not about tractors. It is about leverage. It is about the illusion that rising markets remove risk. It is about how quickly confidence becomes vulnerability when conditions shift. In 1973, the entire environment rewarded borrowing. Banks encouraged it. Dealers incentivized it. Neighbors normalized it. Saying no required discipline. Saying yes required optimism. Optimism is contagious. Discipline is lonely. When cycles turn, optimism disappears. Discipline remains. If you had stood in that barn in 1973 with corn at $3, land climbing fast, neighbors upgrading equipment, and bankers eager to lend, what would you have done? Would you have trusted memory over momentum? Would you have accepted slower growth for stronger footing? Or would you have believed that this time was different? Every generation believes it is different. Every cycle convinces participants that the old rules no longer apply. And then the math reasserts itself. The farm crisis of the 1980s was not caused by laziness. It was not caused by lack of effort. It was caused by leverage meeting volatility, and volatility always returns. Today, machinery costs are exponentially higher, technology more advanced, financing more sophisticated, terms more complex, but the principle has not changed. Debt amplifies both gains and losses. It removes flexibility, and in industries where price and weather are uncontrollable, flexibility is survival. Marcus learned the hard way. Daniel stepped away before the collapse. Isaiah listened to an old man who remembered hunger. 3 brothers, same land, same upbringing, same work ethic, different structure, different outcome. The old man's warning was not dramatic. It was simple. Never finance tractors or equipment. 2 sons heard tradition, one heard truth, and only one passed the land forward untouched.